How I stopped trading. My emotions and built a real edge. The cursor hovered over the sell button while the 5-minute candlestick ripped back toward my entry. My stop loss was 2 ticks below the wick, a line I had promised myself I would not touch. Then the platform flashed a tiny, unrealized P&L number in green, and my brain did what it had always done. It whispered that I could just give it a little more room. The spread widened. Level 2 thinned out. The bid evaporated, and I felt adrenaline tighten behind my ribs. A second later, I did what most traders do when the market presses their beliefs. I pulled the stop. The next candle sliced straight through where my risk should have been, and the green number turned red so fast it looked like a magic trick. I watched a simple plan dissolve into a familiar spiral. I could feel the urge to get it back, building in my jaw as I clicked around TradingView, drawing new support lines and inventing new reasons. It was the same old movie, and I was the guy buying popcorn in the front row. Here's what I didn't understand then. I wasn't trading the market. I was trading my own chemistry. Every green print popped a dopamine bubble. Every red tick spiked cortisol. Volatility felt like energy, and energy felt like opportunity. Even when there was no setup, I could identify RSI divergence and mark out liquidity pools. I knew my moving averages and my risk-reward math, but I didn't know myself as a trader. I thought discipline meant forcing my feelings to submit. What finally worked was colder and kinder. I stopped asking my emotions to behave, and I stopped letting them lead. I built a real edge around them, like a guardrail around a track, not to prevent speed, but to decide where speed belonged. Most traders lose money, not because markets are impossible, but because our default brain wiring's terrible for placing risk inside uncertainty. We are pattern-making creatures, and charts are Rorschach tests in neon. In tight ranges, we hallucinate breakouts. In trends, we hallucinate flaws. We're social animals, with mirror neurons that copy what other traders do. So when a room starts shouting, "Buy the dip," we feel the urge even as volume is dying. We're storytellers who crave control, so we invent reasons that let us move stops or chase candles so we don't have to feel wrong. Your platform's a casino floor with better lighting, and the chips are your attention. Every sound, every colour, every flicker of the order book is engineered to trigger impulses you'll justify with words later. The hidden mechanism is simple. A small green print gives you a dopamine hit, which biases you toward action and optimism. You hold a loser because exiting is a prediction error. Your brain hates admitting models are wrong, so cortisol keeps you locked in the fight or flight tunnel. Add adrenaline when volatility spikes, and now your time horizon collapses. Your prefrontal cortex, the part that holds rules over impulses, loses bandwidth. That's why your process feels perfect at 8:30 a.m. on paper and melts by 9:47 a.m. on a sharp pullback. That's also why more analysis often makes your trading worse. When your brain is anxious, it hoards reasons to protect the self, not to improve the trade. Past patterns don't guarantee the future, but your brain will guarantee you feel sure anyway. So we make costly patterns. Entry hesitation paralysis on A setups because the last loss is still ringing in your ears. Exit greed extension on B trades because the last winner ran after you took profits. Stop loss removal syndrome because a tight line in red feels like identity loss. Revenge trading loops because red P&L threatens self-image and you're wired to fight threats. Overtrading compulsion because doing nothing feels like doing something wrong. Chart pattern hallucination because 10 indicators make a messy chart look like a safe chart. Tighter stops become bigger losses because you nudge a line 3 times and then rip it completely when price grazes it, turning a planned bruise into a broken bone. The paradox keeps repeating. The perfect setup fails most often because the crowd sees it too. The best trades feel uncomfortable because you're buying fear and selling relief. More screens give less clarity because your attention fragments. Risk management is survival, but most of us don't manage risk. We negotiate with it, like it's a person we can charm. The way I broke the loop wasn't by becoming a monk, it was by becoming an engineer. I built a trading environment that made my worst impulses hard and my best behaviours easy. Not financial advice, but here is exactly how I stopped trading my emotions and built a real edge. I created a character I could be proud of, when the market was trying to take that pride away. His name is Marcus, and he trades like an algo hybrid. He uses TradingView for charts, but he doesn't stare at them once a position is on. He reads order flow to locate urgency, but he won't click because the tape looks exciting. He codes alert conditions for his setups, even the discretionary ones. He lives by the line, emotions are data points, not commands. He keeps 2 monitors, not 5, and a notebook that matters more than any indicator. He thinks in probabilities and position sizes, not in outcomes and wishes. He doesn't try to be certain. He tries to be consistent. The first time you see Marcus, it's 7:52 a.m. He's not loading a watch list of 100 names. He's finalizing 3. Each has a clear setup, structure on the higher time frame, a trigger on the execution time frame, a precise invalidation line that doubles as the stop loss. He writes the entry, stop, and target in his journal before the open. For each, he records the volatility regime, average true range, and where trapped traders likely sit. He measures the distance to the stop and divides risk into his fixed R, so the size is decided before the bell. He codes an alert on the trigger, not the price. Break and hold above VWAP with rising delta into prior day's high, so he doesn't have to babysit candles. He sets a daily loss cap in the platform, so the session stops him if he won't stop himself. He keeps a tiny paper note taped to the bottom of the screen. Flat is a position. When the bell rings, Marcus lets price come to him. The first spike triggers the impulse to chase, and he notices the micro tremor in his forearms. That's adrenaline data, not an instruction. He forces his eyes to the plan. The entry is a break and retest with buyers defending the level on the footprint, not a break alone. The alert fires 10 minutes later with the retest. Delta flips positive, and the selling fails to push the candles below VWAP. He clicks once, position opened, stop loss placed at the line written at 7:52 a.m, not below it, at it. He locks the bracket order and hides the P&L display. He watches the order flow for one thing only. Is the behavior he expected still there? If buyers vanish and absorption flips, he exits without a story. If the thesis remains, he does nothing. Doing nothing is the edge. He will scale partials at the first liquidity pocket, above range, and move the stop to break even only if the market proves his trade with intention, not if he feels nervous. He is trading his plan, not his pulse. When the first partial hits, dopamine will try to make him lock it in, but he's already told his platform what to do. His rules are mechanical because his feelings are not. Marcus didn't start here. He used to average down because his identity hated being wrong. He used to pull stops because he confused flexibility with sabotage. He used to watch 5 time frames because more information felt like more control. He blew up a month by winning big, tripling size, and then giving it all back in 2 hours because he felt invincible. Then he changed the structure around his worst tendencies before he tried to change the tendencies themselves. He made pre-market rituals that quieted his nervous system. 10 deep nasal breaths with longer exhales to lower heart rate variability before inputs. A 3-minute if-then mental rehearsal. If my first trade stops out, then I will reduce size by half and trade only one more setup. If my first trade wins, then I will not increase size for the next trade. If I feel the urge to move my stop, then I will stand up, read my stop aloud, and wait 2 minutes. He practiced these until they felt like muscle memory. That way, when cortisol spiked, the rule fired before the story did. He carved the biases into labels he could spot and neutralize. Entry. Hesitation paralysis is a sign of risk aversion, spiking after a loss. The antidote is a smaller size and a timer to let the setup complete. Exit greed extension is the brain chasing a bigger dopamine pop. The antidote is to pre-place partials and a trailing stop that moves only when structure moves. Stop loss removal syndrome is identity protection. The antidote is to define being wrong as refusing to take the stop, not taking the stop. Revenge trading loops are predictable. The antidote is a written cooling off rule with an enforced 20-minute break after any 2 consecutive losses. Overtrading compulsion is boredom seeking arousal. The antidote is having non-trading tasks you can do that keep you in the chair without clicking. Stats updates, journaling, backtesting. Chart pattern hallucination is cognitive overload. The antidote is a minimal template with price, volume, VW up, a moving average you trust, and one momentum measure. Clean charts, clean decisions. He built his edge like a system trader, even where discretion lived. He catalogued his setups with tags, PB VW up, break retest, first pullback after opening drive, failed high at prior day's high, reversal at daily level with RSI divergence. For each tag he recorded the time of day, the volatility, the average excursion, the average adverse excursion, and the hit rate. He kept a rolling 20-trade sample for each tag to avoid recent bias. He accepted that most patterns are random without context, so context became part of the tag, trend or range, trapped side, location relative to liquidity. He treated uncertainty as a parameter, not a problem. He noticed that his A setup win rate held steady, but his B setup losses clustered after green mornings, so he built a rule: no new B setups after +1. 5R on the day. He was no longer arguing with the market. He was negotiating with his own history. He addressed neuroscience with structure. Dopamine makes you click, so he reduced click opportunities. He disabled market orders entirely and forced himself to use limit or stop limit orders at predefined levels. He hid his P&L. He replaced it with R on the chart, so a trade was not dollars, but units of risk. He set his platform to auto-close the chart of any symbol after a stop is hit, so he could not chase the same name from anger. He put his phone in another room, so he couldn't doom scroll chat rooms, and mirror the emotions of other traders. Mirror neurons can help when you're surrounded by discipline, and destroy when you're surrounded by hype. He attacked the paradoxes head-on. Perfect setups fail often, so he stopped adding size because a setup looked perfect. He risked the same per trade regardless of how pretty the screenshot looked. The best trades feel uncomfortable, so he measured discomfort and normalized it. If his palms weren't a little sweaty on a proper entry, he might be too late. More analysis was making results worse, so he capped prep to a checklist and a fixed block of time, trusting that clear rules beat endless tinkering. Tighter stops were causing bigger losses because he moved them. He widened stops to where the trade was truly invalidated and cut size to keep risk constant. More screens had been giving less clarity. He went down to 2 panels, execution timeframe and 1 higher timeframe. That was it. He built a journal that wasn't a diary of feelings, but a data-rich autopsy of decisions. For each trade, he asked, did I trade the plan I wrote? If not, why? Was the market behavior consistent with the thesis? If not, where did it diverge? Where were the trapped traders? What did order flow show at entry and exit? Did I manage according to structure or sensation? He marked tags for biases that appeared: hesitation, greed extension, stop move, revenge impulse, overtrade. He graded not the outcome but the process adherence. Because trading is probabilistic, a good loss is a win. Because drawdowns are inevitable, his confidence came from following rules while read. He accepted statistics like a casino owner accepts variance. He planned for streaks. Most traders lose money is not a curse. It's a sign that survival is the first edge. He set a maximum daily drawdown and a maximum weekly drawdown. He stopped for the day at -2R and stopped for the week at -5R. He let his winners run according to structure, but didn't let them convince him he was a genius. He used fixed risk so a streak could not exaggerate his ego on the upside or shrink his courage on the downside. He saw that probability thinking is not optimism or pessimism. It's humility armed with math. He added one more layer, the paradox that more structure can create more freedom. He scheduled no trade windows, lunch chop, last 10 minutes of the day, unless managing an open swing, so boredom could not trick him into action. He set hard rules for margin, never increase leverage after a loss, never pyramid without fresh structure. He saved screenshots of the trades he didn't take that matched his plan and would have worked, and instead of beating himself up, he used them to refine his alerts so next time the platform would call him. He believed a flat position is not missing out, it's optionality preserved. Over time, the emotional storm still came, but they hit walls. Entry hesitation paralysis still whispered, but the alert fired, the order placed and the size small enough that he could act. Exit greed still tempted, but the bracket had a partial at the next liquidity pocket and a trailing stop at structure, and he couldn't move them without unlocking the order and confronting a conscious decision instead of a reflex. Stop-loss removal syndrome still knocked, but the definition of discipline had changed. Moving a stop was breaking the identity he wanted. Revenge trading loop still flashed rage, but the daily cap cut him off and forced him to write. Overtrading compulsion still buzzed, but with no market orders and no anywhere clicks, it took real work to sabotage himself. Chart pattern hallucination still made shapes out of noise. But he no longer believed every drawing. The tag had to match the regime, the tape, and the level. One afternoon, the platform froze during volatility. The old me would have panicked. Marcus executed the platform freeze protocol he had written on a sticky note months ago. Hedge or close via the broker's phone app. Log the time and screenshot. Do not re-enter for 20 minutes. He did exactly that. Took the small hit and didn't go back to win it back. Because winning back is how you lose forward. Little by little, the identity shifted from I predict to I align. The market is always right. My job is not to be right. It's to enforce my risk and express my edge. Edge is not a feeling. It's a repeatable mismatch between how the market usually moves and how you usually behave. My mismatch had been emotional. Now my edge lived where emotions used to. Here's the picture now. Calm in volatility, because position size carries the fear. Stops are hits I accept, because wrong is an event, not a verdict. Drawdowns are part of the distribution, not a signal that I'm broken. I still have red days. Past patterns still don't guarantee the future. Risk management is survival, so I aim for longevity, not lottery. I design for boredom and terror alike. Boredom gets rules that keep me from clicking. Terror gets protocols that shrink time back to the plan. What changed? I stopped negotiating with my feelings after the entry and started negotiating with them before the bell. I stopped believing that more certainty would make better trades and started believing that better defaults would make more consistent ones. I stopped asking to feel confident and started asking to be consistent. The market didn't become easier. I became harder to move. If you're stuck trading your emotions, build your guardrails, decide the setup, decide its trigger, decide the invalidation and the stop, decide the position size, decide the management, decide the daily and weekly circuit breakers, decide the no trade zones, decide what you will do when you feel the urge to break any of these. Then move those decisions out of your head and into your platform and your environment. Alerts, brackets, hidden P&L, limited screens, no market orders, coded tags, fixed R, daily caps. You can't stop your brain from spiking dopamine on green or cortisol on red, but you can make sure those spikes hit stone and not your account. The day I watched price tag my stop without me touching it felt like a loss and a victory. I closed the platform, wrote the notes, and went for a walk. I passed a cafe with a screen showing candlesticks and a table of traders arguing about a breakout. The mirror neurons reached for them, and I smiled. I don't trade other people anymore. I don't trade stories. I trade my system when my system says I have a trade, and I stop when my rules say I'm done. Maybe that sounds boring. Boring is what consistency feels like from the inside. The excitement now comes from the craft. Tagging setups, finding that my A setup held its stats through 3 months, seeing my average adverse excursion shrink because my entries got cleaner, catching myself moving a stop in my head and watching my hand stay still, because the rule had already decided. That's freedom. That's a real edge. It's not flashy. It's not a secret indicator. It's a structure designed for a human nervous system that will always crave certainty in a place where certainty doesn't live. Most traders lose money. Past patterns don't guarantee the future. Not financial advice. But if there is one thing you can guarantee, it's this. If you stop trading your emotions and start building around them, your worst day will be survivable. Your average day will be repeatable. And your best day will be the byproduct of rules you followed long before the bell. That is the only kind of edge that lasts.